And since you're all here, I assume you'll know the Zoom meeting and all that. Oh, one thing I do want to see. Has anyone tried I just put the ebook links in yesterday. Does anyone give those a shot? Do they work? Oh, they work. Yay. Okay. The only reason why I asked is that they were different this time around. We had to do some stuff on my own. Boy, do I hate that. So anyway, good. I'm glad that they're working. But anyway, so let's look at the syllabus. This is part of the Laker bundle, and what I almost always give you the problems in that and I think I can say it. I always give the handouts because I change them a lot. So a lot of the problems that we do, okay, Sebastian, Sebastian, let me make note of that. I will see if we can get that figured. Okay. Okay, so this is kind of what we're gonna be going over the learning objectives. You can look through those if you want. Gives you kind of a heads up what's going on with the course. Okay, submitting work. Everything is turned in Blackboard. Hey, I must have my spacing. And let's see exactly what I mean by that. Let's go to Blackboard and go into, nope. Yep. Under assignments, now this is the first assignment we have, and you'll notice that the handouts that I just emailed to you are in there. So if you can't open the documents in your email, sometimes the email gets mad, it doesn't let you do stuff. You can always come here and get them. So under the assignments, so here's the assignment for today. And you'll notice that it's due 9/5, which is a week from Friday. Hopefully we'll finish it today though. But it'll be, so 9/5 will be when it's due. And what you'll just do is click on this and submit it. Now you can submit it any way you want. Pretty much, I should say. You can write right into the file if you want. If you want to just pull up the file and write directly into it, you can do it that way. Just put in your answers here. You don't need to put your name on. Well, you can if you want, but you don't need to put your name on it. It'll go right to your account when you submit it. But you can do it that way, or you can do it by hand. You can write it out in a notebook. If you print it out, you're going to take a copy of take a picture of the printouts. You can always just take all the pictures you want and send them in that way. So there's any number of ways you do. So you can do it with a file. You could scan it if you want. If you have printed it out, you can also just take pictures of it. There are two things. Let me write these in. There are two things that you can't submit it, and that is and Blackboard does not like zip files. That's in Windows 10, Windows. or page files. It doesn't know what to do with them. So do not use zip or page files when you submit them. And I know it's easier to submit them that way. I wish Blackboard took those, but for whatever reason, it doesn't take zip or page files. And it's even worse than that because I can't do anything about it. What shows up if you try to load it as a page file or a zip file is it shows it's pending, and I get this clock going, and I can't reset it. You have to go in yourself and delete that out and then submit it because it literally blocks it till. And again, and I can't. There's nothing I can do about it. It shows pending as if you're just, if you're downloading and have the information, it's uploading. But what's really happening is it'll never load, and because it never loads, I can never, delete it and have you do it again. You have to delete it. So don't use page or zip files. And again, I wish it would be very easy. It'd be much easier if it allowed that, but for whatever reason it doesn't. So there we go. All right. Usually assignments are due 1 week after they are assigned. Usually I go 1 week plus Friday. So I guess so 1 week plus Friday is the 5th. So that I usually go to the 1 week after the Friday. Now, late work is accepted without penalty. So if for whatever reason you can't turn it in on time, you can still turn it in and get the full grade for it. I don't take off anything. So let's say that you don't get this handout turned in by the 5th of September. You can still turn it in and you get full credit. Now, as of the 5th, though, I go through and do the grading. So usually on the 6th, it will be included in your grades. Now, if there's nothing there, your grades are going to look bad, but they're just going to look bad until you get that assignment. So I wait until the due date to actually include those in your grade. But you can still turn it in, even if you don't get it in by the due date. Basically, everything has to be turned in by the end of the semester, by the end of the term. And quite honestly, that goes back to the thing I skipped over here. These are the course learning objectives. And as long as you cover those objectives, it doesn't matter to me too much when during the semester. So anyway, late work is accepted without penalty. It won't be in your grade until it's turned in if it is late. And here's a grading for the class. Okay. Grading scale, you guys are probably familiar with that. A little bit of a change from what you probably would be thinking about for this handout, and that is, say, why aren't we starting with chapter 1? We're starting with chapter 2. Okay, well, chapter 1 is one of the most difficult chapters in all of accounting to really understand it. It's kind of it's CPA exam kind of stuff that is pretty. It has a lot to do with logic and things like that. So anyway, we're going to put that off till near the end. It's just easier. You get a little bit more accounting done, and you start to, as we go through these other things, it'll start to become apparent. More of these will become apparent why we're doing it. But anyway, we're putting it off the end. Part of the reason why is that if we do chapter 1 first, a lot of people go, "Oh, this isn't for me," anything. But it's one chapter. It's not going to be whatever. And we'll go through. We'll go through what you need to know for it. But there's one more thing I got to talk about. And that is I don't have it in here. Okay, I need to put, I need to add something in. I guess you write this in somewhere. Exams are email. Oops, they are not available in Blackboard. And they're very similar to what we do in class. So exams are only emailed. They're not included. So assignments are emailed and they're available in Blackboard. Exams are only email. And there's a reason for that. The reason for that is that there'd be different versions of the exam. Form 1, Form A, Form B, Form C, whatever. So you'd have different ones for different people. So anyway, we're going to, those will be emailed to you, and then I'll tell you in the class when I'm going to email them. Well, I'm probably going to email those out for chapter 2 next week. Any questions on that? So exams are emailed. They're not available in Blackboard. So you can't go into Blackboard. They're not going to be, you'll be able to submit them in Blackboard, but you won't be able to get the actual exam itself. Any questions? And again, however you want to do it. So today, you're taking notes. If you're writing on notebook paper, that's fine. If you printed it out, that's fine. If you want to do it directly into the file itself, there are spaces in there so you can put it into and just submit the file. And again, you don't have to. It submits it by your name anyway, so you don't really don't worry about it. Have to put your name on it and all this kind of stuff. You can't, no problem. But you don't have to. You can just resubmit it back in once you fill it in. All right. Any questions? All right. What we're going to do is we're going to go into the chapter 2 is a review basically of chapter 2 in accounting 210. And we're going to kind of go over it and do the journal entries, and hopefully you guys have had better, had a few accountings, a little bit of accounting, so now you know, and maybe it'll make a little bit more sense of the second time. The intermediate classes, by the way, are really what gets tested a lot on the CPA. So intermediate 1, 2, and 3, and they're generally the harder classes. I know it sounds funny, but advanced accounting is generally not as difficult as the intermediate. And there's more intermediate on the CPA exam than anything else. So the 3 intermediate classes are pretty heavy duty, and they've always been. When I was going through, it was exactly the same. Intermediate classes those are the ones that appear on the CPA exam. So when it comes to the accounting stuff, the intermediate ones are important. And we're going to start out doing journal entries and seeing how they come about. And if you struggle doing them the first time around, and a lot of people do, hopefully the second time around they'll make a little bit more sense. But anyway, we're going to kind of go into the handout. We're going to do a little bit of the history of journal entries, and then we will. Oops. Is this what it was? No, it's not. Oh, I know what it is. I'm sorry. That was, of course, me being stupid. Let me try this again. There we go. Hey. What I want to do is actually near the back of this handout, page 6. It goes into how journal entries came about, and it's kind of, I don't know, it's interesting to me a little bit. But journal entries in the past, they looked like that. They were literally journals, like people would write a journal, a written journal. This is what is on page 6, by the way. Oops. So on page 6, so this is what they looked like. So 400 years ago, if you were to look at a journal entries, this is what they would look like. And they were literally journals. You know, the people who did it, like Dracula. The people who did them were basically kind of like scribes, like English, people today. People didn't. There weren't a lot of people writing back then. You didn't need to. Most people didn't need to. But if you were doing journal entries, it was all written. It was handwritten. They would write out, purchased whatever from so and so and paid this much with so and so. Blah blah blah. It was, so that's what it was. Now you can imagine, especially back in the day, you're dipping the feather in the inkwell and you're right, keep dipping and you look for some way to shorten this up. You say, okay, well, this is pretty tedious. How can we write these transactions and do it quicker? How can we do it more quickly? And that's where they came up with the idea of debits and credits. And that you grab the accounts you need and you indicate whether they're increasing or decreasing, and you just jot it down. And you can look at that journal entry and you can tell what the transaction is. So it's pretty ingenious. Now, you're basically looking at a 400-year-old shorthand as far as how to make, but it still works. And there's always, it's kind of funny, people hate journal entries so much that they all say, like, well, let's replace them with, we'll do away with journal entries. We got computers, said that. Well, we got computers now. We don't need journal entries. They always come up with something similar to, okay, we won't call them debits and credits. We'll call them righties and lefties. But anyway, did that wrong. No. Anyway, so this is where they were at, and somewhere around that time they started to get into this. They said, okay, we really don't need all this stuff. If we just do this, here's this is the debit side, this is the credit side. They're still writing a little bit there. They're still putting in quite a bit of information, like the address and things like that. But they got the date in and what it's for, and here's the debit, here's the credit. They came up with an ingenious way to know if to make sure that the journal entry is being putting in correctly, or attempted to anyways, by separating out debits and credits. Anyway, so this is what it became. So instead of doing this, now they got it down to this, and now we're going to get it down to even less. Now page 7 and 8 both kind of tell you how to do it. And if you're familiar with debits and credits, you may not be terribly interested. My light's off. My Dracula light is off. Okay, so revenues are virtually always credits, and expenses are virtually always debits. And there's a reason for that, and that is because they're constantly going up. 2 days revenue is usually more than 1 day's revenue, so this is what they increase with. Where's my pen? And as the year goes on, these two accounts will virtually always increase. So revenues increase with credits, expenses increase with debits. Rent expense, 2 months of rent expense is more than one. They're always going to be increasing as the year goes on. So revenues are virtually always credits, and expenses are always debits. And if you run into those, you say yippee, because you know exactly what they are, the debits and credits. And once you know a debit, once you know one of them, you know the other one, right? I mean, if you do the journal entry. Okay. Assets. They increase with debits and they go down with credits. Liabilities and equity are just the opposite. Oops. So assets go up with debits. Liabilities and equity go up with credits. And basically, if you look at what do you spend money on, you spend money on assets and you spend money on expenses. Those are debits, things you spend money on. How do you get money? You can borrow money. You can get it from the owners, or you can sell something. So how you get money is a credit. So either you borrow it, credit. So either you borrow it or get it from the owners, or if you make a sale, you can get money. What do you spend that money on? You spend it on assets and you spend it on expenses. The last page here is even a kind of simpler table. And this kind of breaks down what they are, what you see. And you'll notice like this is the balance sheet, assets equal liabilities plus equity. And this is kind of the one that if you think about the balance sheet, this is kind of the whole company basically is in here. These expenses and revenues go into the equity. So, this is it. And if you look at this, you'll notice that they increase on the outside. These are on the outside of it, the increases, and you don't know. So if you borrow $1,000 to buy some equipment, well, you have more liabilities now. You have 1,000 of liabilities, and you have 1,000 of equipment. They go up together. And so, these two will go up. Is it possible that you having the same? Yeah, if you would have paid cash for the equipment, your cash would have gone down. You have a negative on the cash. It's an asset, and you'd have a positive on the equipment. So this debits and credits thing it's really pretty ingenious that they came up with this. And like I say, they always try to replace these, but they really, if you're gonna, you really can't, because something has to happen. And if you just think about our balance sheet, what do we know about the balance sheet? It has to balance, right? So the balance sheet has to balance, and because it has to balance, you can't just change one side. You can't just have a single entry, right? If they're both at whatever $200,000, you can't just say, okay, there's gonna be more assets on this side. It's not gonna balance anymore. You have to do something else. So that's why what they call a double entry system. And yeah, so it's a little bit more. It's a good system because it really ensures that you're not necessarily you do the journal entry completely correct, but it helps to ensure that it's a better indicator that it is correct if it balances. So the journal, that's why the journal entries must balance. The balance sheet has to balance. You can't just change one side. So you have to, you have to do it on both sides. Okay. I didn't mean to hang on this. No, I'm not. Okay. So let's go to our blank. Go to this thing. And we will go through here. The first one is actually the more difficult of all of these, I think. So what we're going to do is we're going to make the journal entries. And then we're going to take those journal entries and post them into our general ledger. do our trial balance, and finally, our income statement, and that's, yeah, kind of, this is the whole accounting cycle, so that's what this is. You're wondering what this is kind of a looking at, it's the accounting cycle. Okay. Let's go ahead and do this. So these are the March journal entries. They issued 30,000 shares of no par common stock for 300,000. I imagine these are the dates. We'll just put these in as the dates. So this will be 3/1/7. Okay. So the company issued stock for 300,000. $300,000 is in what kind of an account? Cash, right? So that's a cash account. And one of the things I also want to talk about a little bit is this are the source documents. Wait, where are they? Like orange. Okay. When it comes to making journal entries as an accountant, you know, if the question is how do you know when to make a journal entry? Well, you're going to go through the source documents to do it. And if you're planning on taking the CPA exam, this is really important because these are what you look at when you're doing an audit. So if you see that they have this journal entry for the 300,000 shares of stock, excuse me, 30,000 shares of stock for $300,000, you're gonna say, how do I know that they did this? How do they know that that transaction actually happened? How do I know that they just didn't make that up? Well, you're gonna look at two different things here. First of all, they should have the stock certificates with the names of the people. Which now, of course, you can't read because I use the wrong people. I should throw those out. All right. And probably more important than that, there should be a deposit list and a matching deposit slip from the bank. So the bank will have a deposit slip, which should also be on the bank statement. This comes from the bank. So this deposit slip is actually, if they have a deposit slip for 300,000, that's pretty good evidence that they actually did this, that the 300,000 was received. Okay, let's go through the journal entry for it. So we know that one side is cash. Let's just stop and do that. Let's do this cash first. Does the company have more cash or less cash now?
Would it be less? Would it be an asset?
Well, it'll be an asset. They'll actually have more. Now the company has 300,000 that they can do whatever they need to do to be in business. So they actually have more. Cash is what kind of an account? Actually, cash is what kind of an account?
It's an asset.
Asset, and it's going to increase with a debit. Okay, so I'm going to write that in. I'm going to write in big annoying. It's right pen. It is right. Okay. So I'm going to write cash. You don't need to write this next part I'm doing. It's an asset, and it's going up. They now have 300,000 more cash. Okay, now, right now our balance sheet doesn't balance, right? Because there's going to be a $300,000 in cash. There's not going to be anything else, and so we need to balance out our balance sheet. So, what other account are we going to use? Looking at these two, what accounts are we going to use on this side?
would it be equity?
It'd be in the equity and it'd probably be the stock. So is it common stock? It's probably common stock, right? Yeah, common stock. Okay. So we have common stock. Now we have more owners now. I think this is the only owner, but we went from 0 owners to 1, so we have more owners. So this is going to increase the equity. So the owner now has, the ownership is 300,000. It's going to increase. So we're going to put in common stock. And that's an equity account. You don't need to write this. Going up for 300,000. So if you looked at our balance sheet right now, it looked like this. This would be, you have 300,000 in cash, and you have 300,000 in equity. Yeah. So this is then this still balances. That should be a K, not an H. And again, if you're an auditor and you're auditing this business, you look to see if they have a deposit slip from the bank, or even a bank statement. And if they have a bank statement and deposit slip, it probably means that it was a valid entry. Okay, purchased equipment at a cost of 40,000. Cash of 10,000 was paid, and a note payable. The seller was signed for the balance. Okay, and this is. By the way, can you guys hear the air conditioner? Is it making a buzzing sound? No? Okay, good. All right, so let's see. So we purchased equipment. Well, let's take the equipment first. Do we have more equipment now or less? We just bought the equipment for 40,000. So when it comes to the equipment, just the equipment, don't worry about the cash or the note. Just the equipment. Do we have more now? More equipment or less equipment now?
We have more.
We got more. All right, so yeah. No, I'm gonna put my chat on if you guys are answering it. And yes, yeah, so okay, so we have equipment. So this is our equipment. Oh, anyway, I can line. All right. And it's going to increase with debit. We now have more equipment, so we can put that one in. Okay, so equipment, it is an asset, and it's going up by 40,000. Okay. Oh, I didn't go into the documents. I should probably do that. I'll do that. Let's do the journal entry first, and I'll go back to the documents. Okay, so they have equipment. Let's go to cash. cash of $10,000 was paid. So we got the equipment, but we paid 10,000 of cash, and then we have a notes payable for the rest of it. But let's take the cash next. Cash, is it going up or down?
Down.
Down. Good. So our cash is going down. So cash is what kind of an account?
An asset.
Yep. Asset, and it's going down. So it's going to be a credit. So cash, it's going down. It's going down by what, 1,000? Cash, and again, you do not need to write this little. I'm writing this little note in just so you know how I got the journal entry. It's an asset. It's going down by 10,000. And last but not least, it isn't. This is the most, that's the least, and this is kind of the middle one. The middle one is the notes payable. Now, do we have more liabilities now or less?
We would have more liabilities.
Yep. Liability. So we're going to have a notes payable. And it's going to increase. We now owe 30,000. 30,000. Yep. So now we owe 30,000. And so we assign this notes payable for 30,000. Oops.
Quick question, why wouldn't it be accounts payable?
Usually a note is a signed document. That's a good question, and there actually is, some questions about it too. If because it's a little bit different in that a notes payable is actually a signed document, whereas usually an accounts payable is going to be a revolving account. Sometimes also a notes payable will have interest, where oftentimes the accounts do not, but they're very similar and they're very, if you put in accounts payable, I can tell you that from an auditing standpoint, they probably wouldn't be that big of a thing. But because they're both most likely going to be current liabilities. But they, the distinction is that it's actually a document. A note is almost like a check. It's a signed document, but they're very similar. And sometimes you'll just see companies will just say payables, and they'll have all of them in there. Now, technically, sometimes they'll break those out on the blank here, statement of cash flows, which we're not going to do today, but because this is technically a financing rather than a business operation, but they're when it comes to the financial statements, they're basically the same thing. All right, so the notes payable, and I'll put it to you this way: if you just put a payable on the test, that would be fine, whatever the payable is. So notes payable, 30,000, and I don't have enough. Well, maybe I do have enough. I'll write it here. So this is a liability, and it's going up. And this is the one that people sometimes get confused on. They say, "Well, won't that be negative?" It's actually we owe more money. So this is liabilities are what we owe to other people. This is owed. So it's sort of like this. This is owned. And this is owed. So when we owe somebody else, what we owe goes up when we sign a note. Okay. Well, you're doing an audit. Here we go. You're doing an audit and you want to know if this is actually a real transaction. What do you look for? Well, for the equipment, you probably have a purchase order. You should. Smaller companies may not. The company you bought it from will give you an invoice. So that's a third party giving you an invoice. That's better evidence. You should have a receiving report for when you actually got the equipment. Now, another thing too is if it's a piece of equipment, usually you can go out and take a look at it. It doesn't prove that you own it, but you can prove that it exists by going and taking a look at the equipment. Okay, now how about the payments? Well, if they paid, they should either have a canceled check, or if it was done electronically, it should be on the bank statement. And you say, well, what about that note? There should be a note payable. You should be able to look at that. There should be a document, a note payable with your signature on it, showing who you owe and how much and all that. So this is kind of how you go through the documents. And people, when you make your journal entries, it'll come through your accounting system usually if you're making them separate. But this is basically what they're making those journal entries on, are these source documents. Something has to happen, and there's a documentation for it. And I'll tell you, this comes into another kind of what can be a problem, and that is a lot of times you have these small businesses, they might deal in cash. Maybe they deal in cash because they have to. If you're buying scrap metal or something like that, people show up with the scrap metal and they want cash. They don't want a check from you, they want cash. That makes it much more difficult to audit. Sometimes you can't do it. If they do all their transactions in cash, there is no paper trail. You're not going to see a canceled check. You're not going to see all these other pieces of data. So sometimes, usually this is smaller businesses that they won't have a paper trail, and those are businesses you can't audit because you can't get enough information to actually make a decision on whether it's. I keep misclicking here. Okay, so yeah. Oops, I turn on my Dracula lights. All right. So let's take a look at purchased inventory on account. Okay. For 90,000. The company uses a perpetual inventory system, and probably most companies do nowadays. Okay, so the question is, what do we do with that? So we purchased inventory. So do we have more inventory or less inventory now? It's purchased 90,000 of inventory. Do we have more or less? More. Yep, good. So our inventory is going up. And look at our sheet here. What kind of an account is that? I'm doing the earthquake. Whoa. Yeah, good. It's an asset. And I think I'll put that in orange because it's going to be going up also. So inventory, it's an asset, it's going up, so it'll go up with a debit. Okay, one more with the earthquake. Whoa, whoa. All right, so let's put the date in here. Oops. Get to the right. Here. All right, so this is 3-37. So we have inventory, and if it was a periodic account, you'd use purchases. Most businesses nowadays are just going to use inventory. Inventory, this is an asset going up. We now have more inventory, 90,000 more. Already made it orange. Oh. Not beyond the accounting, I should do. Okay, so this is our inventory, it went up. All right, we didn't pay cash for it, we bought it on account. So apparently we have an account with these people, whoever they are, that we bought the inventory from. We're gonna have to pay it in the future, we haven't paid it yet, so what is that gonna be?
That would be accounts payable, a liability.
Yep. Yep, that'll be our accounts payable. And again, we owe more. Now we owe 90,000 more, 90,000 more. So the liability is going up. We owe more money now. We owe 90,000 more. So accounts payable would be a credit. I'm gonna put it down here. Liability. And it's going up. We owe more people now. Oh, 90,000. Oh, I didn't go to my sheet. Or did I? No, I didn't. Yeah, I did. Pink. Well, this on the account, this should be pink. Okay, now source documents, depending on when you bought the inventory, you could actually go take a look at the inventory if you wanted to prove this. But as far as the inventory is concerned, you know, what documents are you gonna have? A purchase order, most likely. Vendor invoice, this is good because it comes from a third party. Whoever you bought it from will send you an invoice saying you owe us this money. And you'll have a receiving report that you actually received the goods whenever you received them. So we can prove, won't be prove anyways, this why can't we look at it like a canceled check for this? You know.
Is it because the check would come out of an asset?
Yeah, we didn't pay anything, right? We didn't pay any assets yet. Now we will, eventually we'll have to pay this off, but no cash has changed hands yet. So this, you know, we pretty much would have to rely on the purchase order. Vendor invoice is a good one to look at because that means a third party, someone outside your client, will have made that invoice. And then the receiving report is just showing that you actually received whatever this is. And yeah, and two, if it is inventory, if they haven't sold it all yet, you could probably go take a look at it and see what they bought. Go out on the floor and take a look at what the inventory is. Okay. Let's go to and I just realized there's an error in my handout here. I need another I need another row. By the way, I should probably tell you guys something else. I've decided to completely redo. I've taught this class many times, but I decided to completely redo it. I was looking at my old materials. I was like, you know, I got to look at this. And for instance, I added in these source documents because when you get into auditing and take it to the CPA exam, you know, the CPA exam will give you a list of which document would, you know, is the best evidence for whatever this is. for this sale to customer, which documents will be the best, the evidence of them. And, so getting kind of know these source documents is a good idea. And if we do it, all throughout the courses, it'll be this second nature to you. Okay. So sold goods to the customer on account for 120,000. 3, 4, 7. Okay, so sold to customers on account. Well, let's take the easy one. Sold means you're gonna have some kind of a sale, right? You're up here, sale. Nice thing about sales, they are always, pretty much anyways, unless, I guess if someone brought something back, but a sale in itself is always going to be a credit. So for sales, we'll use, it'll always be a credit. Yeah, look and see what account we actually use for sales revenue. Okay. It's a credit. It's going up. Sales always go up. And whenever you look at sales or revenues, they're credits. Kind of comforting to know that. All right. So, they're credits. Okay, so what's going to go on the other side? We sold it to the customers. Now, they didn't give us cash yet, but they gave it to us on account. So they owe us 120,000. What kind of an account is that going to be?
Accounts receivable.
Yes, very good. That is going to be an asset. Our accounts receivable is going up. They now owe us 120,000 more. So accounts receivable is an asset. It's going up with a debit. They owe us more now. Take the sales. Oh, wait, I gotta put the number in here. What am I doing? All right, so this is 120,000. All right, now this is where it gets a little tricky, and this is where I had to add this onto here. They use a perpetual inventory system, which means they update the inventory as they go along. So 70,000 of our inventory has left the building. What kind of an account is inventory? Already did this. Our inventory is an asset, but now we've sold this. So there's 70,000 of our inventory that has just left the building. So do we have more or less? Anyone? Oh, yeah. I'm sorry. Yes, I see it chatting. We have less. So this is going to be a credit of the inventory of what? 70,000. Okay. So let's take a look at that. So inventory. Asset going down, you do not need to write this in. And it's going down by 70,000. It was sold. Now, we're not sad about this. We're happy about this. We paid 70,000 for it. We just sold it for 120. So we're what, $50,000 profit on that. So that's what we're in business for. Okay. And now we got to look at the cost of goods sold. Cost of goods sold is similar to an expense. You say, what's the difference between the expense and a cost? Expenses are usually paid out of cash. And the costs are usually other assets. So our cost of goods sold, we're not paying them 70,000 in cash. They got 70,000 of a different asset. They got our inventory. Advertising expense, you're not going to pay that with inventory. Insurance expense, you're not going to pay that with inventory. So these are all, all these expenses are usually going to be cash. I guess you could talk to somebody into trading a bicycle for repair expense or something, but for the most part, these are going to be cash. This is a little bit different in that you're actually giving them inventory. Now they're giving you 120,000, so you're happy to do that, but the cost of that inventory, you have to take it off the books. You no longer have 70,000 of that inventory. That's going to be in your cost of goods sold. And cost of goods sold is always a debit, just like expenses. And I apologize for not putting enough lines here. Any questions on that? Okay, I tell you what, let's take a break. And we will come back at, let's say be back, let's say 10 minutes. 2:59, so we'll say be back. At 3:09. Okay. Go ahead and take a break. Okay. Go ahead and get going on the next one. There's something wrong here. Okay, paid rent on a warehouse. $5,000. Okay, what do we pay with? Most likely. What do you pay your rent with?
Cash.
Cash. Okay. So we're here. We got cash. It's going down with credit. 3, 5, 7, so we have cash. Asset going down for 5,000. And we didn't get an asset back. We got to use the building, so this is gonna be rent. The great thing about expenses is that they are always debits. The next month we'll have another 5,000, so this rental just keep going up. And actually expenses, if you look at here, because it goes up with a debit. It's possible you have a credit if you overpay your rent or something like that. I guess they can give it back to you and that would decrease it. But for the most part, you're gonna be sitting over here. 1 month's worth of rent, 5,000. 2 months is 10,000, whatever. It just keeps going up and up and up as the year goes on. Okay. So whenever you run into an expense, you know that that's going to be a debit. It's possible it's a credit, but it'd be some kind of wacky thing. Okay, so pay 5,000. And again, what do you look at? You look at a canceled check or electronic funds transfer. That'll show that you paid it. Okay. Paid $6,000 for an insurance company for fire and liability insurance for 1 year period, beginning April 1st. Okay, that is important. And it's important because of this. We're in March, so this isn't going to kick in until next month. Okay, well, let's take the easy one. Paid $6,000 to the insurance company. What do we pay them with?
Cash.
Cash. And we can just cheat and look up here and see what we do with pay out cash. Cash asset. Down. But when you're doing auditing, you really beat up the cash account because virtually everything goes through the cash account at some point. You know, it's hard to think of an account that, or a transaction that doesn't go through cash. You know, it'd be something like exchanging land for inventory or something, you know, I guess you could come up with it, but virtually everything goes through cash. So even though cash might be a very small amount on the balance sheet, a lot of times you'll really beat up that cash account because everything goes through it. You prove out all the other accounts by going through cash. Okay, yeah, canceled check. And there might be a purchase order for it. Sometimes there is, sometimes there won't be for that, but. Okay, now the other side is actually gonna be difficult. Somewhat. Because notice that we're not using this insurance yet. You remember way back to accounting, T10? Your first accounting class, what it would be? I'll give you a hint, it's not gonna be an expense. What is it when you pay some?
Is it a prepaid asset?
Yep. Very good. It's gonna be a prepaid asset and it's gonna be going up. So this, what is this? Insurance. So we have prepaid insurance. It's an asset, it's going up. We now have 1 year's worth of insurance. Now, as the months go by, starting in April, you know, we'll decrease that. But right now it's going in full amount. So this would be a prepaid insurance. That's an asset going up. Again, you don't need to write this in. For 6,000. So you really just traded one asset for another. You know, the cash went down, prepaid insurance went up. Your balance sheet would, the total would be exactly the same. Okay. Paid 70,000 on account for the inventory purchased in 3. Okay, so here's the inventory. Here's our accounts payable. We owe 90,000 on it. By the way, that 70,000 and this 70,000 are not related. Oops. Sorry, this 70,000 and the 70,000 that we're paying are not related. So unhappy coincidence. But so here it is. We're going to pay off 70,000. We're not going to pay the whole thing. We're going to pay off 70,000 of it. So what are we going to pay it with?
Cash.
Yep. And yes, in the chat, your accounts payable will also be a debit. So this will be 377. All right, so we're paying it with cash. Again, just like this one, cash is going down. Whenever it goes down, it's going to be a credit. As you do these, you'll get more, you know. At some point they'll become automatic, and then at some point they become like you almost can't make a mistake. This can't happen like this. Okay, so this is what, 70,000? All right, so that's an asset, it's going down. And now we gotta get rid of that account. And The accounts payable will be a debit, yep. So here's our liability, the accounts payable, it's gonna be going down. I'll make it pink again. No, it's already pink. Ooh, yellow. So accounts payable. Now, how would a yellow mark of the right? Okay, so liabilities are gonna decrease with debits. The liability decreasing. $50,000. These are both decreasing. So, if you looked at this, this would be going down by 70,000, and this would be going down by 70,000. So this side would be 70,000 less, and this side will be 70,000. Okay. Collected $55,000 from customers on account. Okay, so that goes back to this one. So they owe us 120,000. They just paid us 55,000. Okay, so let's take the easy one. Our cash, is it going up or down?
Going up.
Yep. So cash. In this case, it's going up. Debit, got more cash now. And on the other side, what do we have? Go back to the original journal entry. So this is when they owe us 120,000. Do they still owe us 120,000? Nope. Yeah, good. Yeah, good. We're gonna credit accounts receivable. So basically, this is gonna be decreasing another asset. The other asset's gonna be decreasing his account. His accounts receivable. For 55,000. So we're basically just exchanging one asset for another. Now, in real life, you'd be happy to do that because you'd rather have the cash than the accounts receivable. So this is them paying it off. We now have less accounts receivable. So this is all taking place in the asset account. This is an asset going down. So when asset goes up, cash, accounts receivable, they don't owe us that anymore. It's going down. Okay. So these are journal entries, and notice that they are very fast to do. You're just taking, mostly they're just two accounts. You just take the two accounts you need, debit or credit, and you're done. No more of this. It's a shorthand way of writing it, and you can look at any one of these, and you go, oh, okay. You know, it looks like that they're paying off an accounts payable. You don't even have to read this, and you'll know that their cash is going down and their accounts payable is going down, so they're both going down. Means that they paid it. And you don't have to have someone writing out sentences for you to tell you that. Okay. Now, here's the problem with journal entries. They're very fast. That's why we like them. They're very fast. You just take the 2 or 3, sometimes 4 accounts and jot them down, and you're done. The problem is, looking at this, it's very difficult to know, you know, how much cash do you have? So that's what we do for this. This is the general ledger, and we're going to go ahead. These are the T accounts. We're going to go ahead and fill these in, and you just take each transaction. I hope they're all on here. Okay. So we're going to go through each of these. So the first one is cash is a debit for 300,000. And common stock. Let's put it on here. Common stock is a debit for, excuse me, it's a credit for 300,000. You know, in the future, I should put debits and credits and all this. Because it's self-explanatory, but okay, so we've done this one. Put a big check there, so I know that one's done. Let's go to the second one. Equipment is an asset. It's got a debit for 40,000. So there's the equipment. Our cash went down by 10,000. And our notes payable went up by 30,000. The credit. So there's the debit. There's the 2 credits. But inventory, I did. No, inventory's over here. Okay. Inventory, 90,000. Debit. This is, oops, let's do this. Make sure we got that one in. Okay, so inventory debit for 90,000. Got that. Oops, they don't have that. Or 0. Accounts payable, 90,000. Bunch of stuff going on here. Accounts receivable is a debit of 120,000. Okay. Right. Okay, so accounts receivable 120,000. Sales revenue is 120,000. Cost of goods sold. Debit of 70,000. And our inventory is credit of 70,000. I'm gonna make sure I did this one right. So cost of goods sold, debit, inventory, sales revenue is a credit, and accounts receivable, okay. Kind of. Okay. Okay, so that's what we got so far. Let's count the numbers on the first page here. 1, 2, 4, 6, 7, 10, 11. 1, 2, 3, 4, 5, 6, 10, 11. Okay, yeah. Okay, let's go to number 5. Rent expense is a debit. 4 or 5,000. And cash is a credit for 5,000. Prepaid insurance is a debit for 6,000. Cash is a credit for 6,000. Okay. Seven, accounts payable is a debit for 70. Nope. Yep. And our cash is credit for 70. Right, drop down on here. Yeah, maybe. You know what, I'm gonna. Stick with what I did the first. Okay, so 70,000, 70 and 70. Accounts payable 70 is a debit, and our cash is credited, it's going down by 70. Okay, so we got that one. Last one, cash 55,000, accounts receivable 50. So cash is a debit for 55,000. And accounts receivable is a credit. Okay, now I think that's done. Now, 8 and 11 should be 19. 1, 2, 3, 6, 7, 13, 19. Okay. Got them all. All right, so now what we got to do is, oops. All right, so over here. And we're gonna get down to one number. Notice our cash is gonna be one number. How much money do we have in cash? So we're gonna add up both sides, and the biggest side always wins. In other words, whatever's left over will be on the biggest side. At 91,000. All right, so this is. I think that made it worse. 355 minus 91. So I think our cash should be 264. We'll make that. Is that what you guys get, by the way?
Yes.
120 minus 55. Inventory. So the beauty of the general ledger is you can actually see how much cash you have. 264. You know, looking at this, you're not going to find, you know, at least it's not going to be apparent. Some of these are just onesies. And again, the 7090 thing is an unhappy coincidence. There's no reason for it. As human beings, we always try to assign, you know, oh, these are the same. It must be some, you know, sometimes they're not. Sometimes they're just the same. Questions on that? If you want to take a screenshot of it, if you don't have it done yet, you can go ahead and take a screenshot. We'll start filling in the next page. Oh, I don't think I told you guys. The videos are recorded and they'll be posted. I say they'll be posted by midnight. Usually I get them in quicker than that. Usually it has to do with the math is usually that has to do with how fast in YouTube it loads up. Okay. All right, so this is, so I'm going to take this, and now we're going to go to our trial balance. I could have made this a little big. And so you're just going to have one number for each of these. Cash, debit, 264. I apologize for the little tiny spaces. You know what? Those aren't even the same width. What idiot made this? Okay, so 264 for the cash. Accounts receivable is 65. Debit. Make sure you put them on the correct side. Inventory is debit for 20,000. And by the way, you know, you'll notice like all the assets, they're all going to be debits. You could have zero cash, but you can't have negative cash. You know, you could have zero inventory, you can't have negative inventory. Okay, prepaid insurance is 6. And equipment is 40,000. $64, $65, $26, and 40. Okay. Coming down to the payables, these are all going to be credits. 20,000, 30,000. So accounts payable is 20,000. And notes payable is 30,000. Common stock is 300,000. And coming down here, our sales are credits for 120. Money coming in. And we have debits for 70 and 20. This isn't cash going out, there are goods going out. The rent expense is cash going out. Whenever you see a cost, it's usually something that's not cash. Not all the time, but in rent expense. Okay, now these should balance out. Might not balance, it should. Does balance. And so these are the totals, and these should be, they should actually balance, you know, they should equal, the debits equal the credits. If people make mistakes, they usually make it by putting it on the wrong side. Now, notice what would happen if you had the 20,000 and you put it as a debit instead of a credit. How much would these be off by? This side would be 20,000 too high, and this side would be 20,000 too low. The total difference would be 40,000. So if you're off by 40,000, you know, whatever number you get, split it in half and then see if it's a debit credit problem. You know, if you're off by 12,000, maybe look at this. Okay, did I get the prepaid? Oh, no, I got that wrong. So I put it on the wrong side or whatever. So a lot of times if you're off, if you take whatever you're off by and divide it by 2, I might tell you which one you're on. Any questions on that? Hey, we're gonna get this thing done. Woo-hoo. Okay, so this is crowd bounce. We need to take a screenshot of that. Go ahead. I can make notes how to fix these things. Maybe a little wider, so maybe even a little bigger. This is pretty a lot of empty space on this page. There's a lot of cramped writing for no reason. Okay. This is what we came from. Here's the financial statements. And when you do an audit, this is basically what you're looking at: the income statement, statement of retained earnings or statement of equity, and the balance sheet. And then the last one that we're not going to do would be the statement of cash flows. You could do it, but statement of cash flows takes a really long time. Usually. This one probably wouldn't take that much. Wow. Okay, so let's do the income statement. Income statement. It's going to be here. These are the income statement accounts. And by the way, usually the income statement accounts will be at the bottom. And there's a reason for that, in that anything that's on the balance sheet is considered a real account. Kind of a funny name, they're all real accounts, but these down here are, temporary. They're only going to be there for the year or time period. So these are something about nominal account. For instance, this is for 2025 or 2027, I think it is. So once the year is over, you turn these all back to zero and start over. If you go into the next year, so we're in 2025, when we go into 2026, we're going to erase everything from 2025 and start new with 2026. So these all disappear. This up here will stay. So that's why they usually put these at the bottom. So income statement at the bottom. So sales revenue. Oh. Well, this is horrible. Well, okay. That sound you hear is me whimpering on the inside. All right. I kind of can't believe it. And it's so weird because these other ones are the right, you can tell these are the right list. Not sure why that happened like that. Okay, well, regardless. Okay, so here's sales revenue. Yeah. Do your best with this. If you want to do it on a different piece of paper, that's fine too. So sales revenue was 120,000. And we're going to subtract out our expenses and costs. So we have cost of goods sold. That would be a negative 70,000. I think we'll go ahead and do the gross profit. So gross profit or gross margin, either one. 120 minus 70 is 50,000. $120 minus 70 is 50,000. So we made 50,000 on the sale of the goods, but then we still have the rent expense. $5,000, and this will give us our net income. $50,000 minus 5 is 45. Okay, statement of retained earnings. The statement of retained earnings is sort of like the piggy bank for the owners. It looks like they kind of like this. When you take the CPA exam, they really test you on drawing that P. No, but so here's what happens. The income goes in to the piggy bank. So this is what the owners have. So their income goes in and the money is retained until it gets paid out to the owners. So this is keep going, let's keep going. The retained earnings just get bigger and bigger as the income comes in. Now, money is paid out to the owners through dividends. And what's left over is what's retained in the piggy bank. So income goes in, dividends go out. Now, if the piggy bank is empty, dividends can't go out. So money goes into the retained earnings and income goes in, dividends come out. Now, if we're starting, if this is our first year in business, our beginning retained earnings is going to be 0. We're going to add our net income. Subtract out any dividends. They didn't have any dividends. So our ending retained earnings will just be the income. Yeah, I apologize for the spacing on this. Okay, so they made 45,000. That goes into retained earnings. So 45,000 went into the piggy bank. They didn't take anything else, so there still should be 45,000 sitting in the piggy banks. Okay. Assets. We have current assets and property, plant, and equipment. All but one of these will be current assets. Obviously, which one's going to be in property, plant, and equipment? Which of these accounts?
The equipment.
Yeah. So the equipment will be down here. All the rest is going to be up top. So I'm just going to kind of copy. So this will be cash, accounts receivable. Feel free to abbreviate these two. I think we'll just do total assets on this. You could split it up and do, total current assets and total long-term or property plant equipment. And here we'll have equipment. $40,000. Okay. Total assets. $495,000. And we actually have 4 more accounts to put in. Okay, so we have accounts payable and notes payable. I'm assuming those are going to be current liabilities. The notes payable may not be. Notes payable. No long-term liabilities, that'd be like mortgages and all that. Stockholders' equity, we're gonna have common stock. $300,000. And there's one thing that's not obvious. Remember, what else do we need there? Anyone? We're way back to accounting, 210. The owners also have their piggy bank. So these are the owners down here. So they're gonna have their piggy bank too. So the retained earnings, and this will be the ending retained earnings. Of 45,000. And again, that's money that the owners made. They can take it out if they want, but that's how much is sitting in that piggy bank. So hopefully these two sides equal. Oop. Yeah, learn how to use a calculator. All right, so up by 100,000. Is this 394? Is this 395?
Yeah, I think
Yes.
the total assets is 395 because cash was 264, the accounts receivable was 65, inventory was 20,000, insurance was 6, and equipment was 40. I got 395.
Okay, thank you. Yeah. Oopsie daisy. Sorry about that. Okay, so I'll put it down here. Okay, so what a mess. Okay, so this is what our balance sheet's gonna look like, 395 and 395, so those two should equal, and if we do, part of the reason why we do the journal entries is so that this balance sheet it needs to balance, and that's why we do it. But anyway, so that's kind of a refresher about what you guys did in accounting 10. I think it's chapter 2 or 3, I can't remember. So anyway, so this is what you're gonna turn in. And it's actually not due till a week from tomorrow, but if you have it done, you're free to turn it in now. And again, however you turn it in is fine. If you want to scan the pages, that's fine. If you did it on notebook paper, you just take a picture of the notebook paper, you take a picture of those. If you did it in the file itself, you just put the file in. The only thing you don't do is don't take all these pictures and then put it into a zip file or a page file, because Blackboard throws a fit if you do that. So anyway, any questions on that? Okay, well we'll continue on with next week. So nothing, no homework to do. We just did this, so we'll turn this in. Next week we'll probably do a little bit more with this, and then I'll give you guys I'll email you the exam after the class next week. And this stuff is actually really important. You'd be surprised at how much, of the CPA exam is stuff like this. And it's, these source documents, but also journal entries, this kind of stuff. And two, if we, knowing these journal entries and getting used to doing the journal entries, we'll do more of these next week. It's not. I'm turning off my camera, and as you guys know, it's fairly common if you're going to a job interview. A lot of times they'll ask you, "What's the journal entry for this? What's the journal? What if you had this? What would the journal entry be?" And they kind of just want to see, this kind of stuff and how these accounts interact. Everything is done through journal entries. Everything is done in accounting through journal entries. So knowing the journal entries, well, it is important to know the other stuff too, and how they all fit into the financial statements and all that. Knowing the journal entries is really how it gets in, and if it doesn't go in right in the journal entries, then it's not going to be right. So knowing how to do the journal entries, so we'll do more of these, and you just getting used to it. Once you get used to it, it's not so bad. I remember the first, I hate to admit this, but the first couple of accounting classes I got seasoned. And journal entries were like from Mars. I have no idea what they were. And then later on, when I kind of figured out what they were, like, oh, okay, I get it. Just writing, quick way to write down the track. Any questions? So what you're going to do is that. So in here, under assignments, what that is, it won't let me close it though. All right, so in here, you click on this and say submission, and you can create it. Right, what I do. Upload files is probably what you're going to be doing with that. This is probably where you're going to be. And you take pictures, put the pictures in individually. That's fine. Let me show you something about this this case. You can put in as many pictures as you want. I'll show you why. That's how we set this up. So here's the title of it. Here's the files I put in. And submission details. And there's unlimited attempts, so you can put in one file, or you can put in 50. And this should say the highest grade. I'll change that. We don't look for plagiarism, because all the journal entries are going to be the same. So that's what it is. So you can put in as many as you want. The moral of that story. Any questions? And 5 minutes over. I'll make it back to you guys next week. I owe you 5 minutes. Any questions on anything? Okay,
It's good to send,
okay, and if you're still having problems with the Laker book bundle, let me know. Go ahead and send me an email on it. Sebastian, I already got you, but if you're anyone who has who's having a problem with that, let me know and I'll send it to them. Unfortunately, this is something that happens almost every semester, but but anyway, so if you're having a problem with the Laker bundle, let me know, and I'll get a hold of the books. Any questions? All right, see you guys next week.
Thank you, Mark.
If you have a class on Monday, remember we don't have class on Monday, so, all right, see you guys.